Alright guys, so welcome again to Emerald Digital Finance. And yes, I'm making this video due to someone's request on particular confusion that has always been on between what was it called, candlesticks and chart patterns. That is in understanding how to interpret the candlestick and chart patterns. Most people actually get to fuse these things together and then mix it up, and it's ends up giving issues to people who are just beginning to have or want to carve a niche for themselves in the market system. So now let's look at it from this way. Candlesticks and chart patterns are very essential in the technical analysis of both forex, stock, or even the crypto market. In every other financial market, it is very important. Now, it is very important as well for you to be able to identify candlesticks and chart patterns in a crucial way for you as a trader. For you as a trader that are looking for an edge in price prediction, it is very important for you to be able to interpret chart patterns, especially why some traders use them interchangeably. I mean the candlesticks and the chart pattern. Yet these two things mean different things. The candlestick means something, and the chart pattern also means another thing. Regardless of how you may want to target or you may want to say it, they mean different things, although they still interpret almost the same thing. Now, so knowing the difference between these two things are very essential for anybody who wants to be a successful technical analyst or even a successful trader in the digital market. Alright, so understanding candlesticks in forex market or the digital market. Candlestick shows emotion in the market by representing the size of prices or price move. A candlestick packs data for different times into one single price bar. That is the data of different price, maybe per minute, per time, and or whatever we want to name it. It packs everything into a single bar. This data includes the opening and closing prices for a given period. It also shows the high and low points that are reached during this particular period of the trade. Now, why one candlestick can shed more light on the prevailing market condition? A group of candles together form vital trade patterns. They provide more data on what buyers and sellers are doing exactly or currently in the market or per time at which you are checking, and what the price also is doing. Candlesticks patterns predict the direction the price is moving. Also, the candlestick pattern in forex or in any digital market is broadly classified into two categories. The bullish candlestick pattern or the bearish candlestick pattern. I wouldn't be going much into that for the sake of this particular class, because we are analyzing the price chart and the chart pattern and the candlestick to use both of them to be able to interpret the market for a successful trade. So I believe by now you should be able to know, or you already know, what a bullish pattern is or what a bearish pattern is, or even the terms and the terminologies and words that we actually use in the trading system. So by now I believe you should be familiar with them, and if you are not, you can go to the description below to get any of my course on introduction to trading. So like in the bullish candlestick patterns, where which we have the hammer, we have the bullish engulfing, we have the morning star, and so many more. We won't be going into that. Also in the bearish engulfing candlestick, the hanging man, the shooting star, and on. So those are basically one of the very popular candlestick pattern that we know in the trading system. So now let's look at the chart patterns of forex, which is the main thing we are going to actually be discussing. So chart patterns in forex are a graphical representation of price movement consisting of high and lows. Unlike candlestick patterns, they present themselves over several trading seasons. Candlesticks just show for a particular period, but these chart patterns show for a longer period. They are no different things. Understand me? It is still or let me just put it this way, your chart patterns are set of candlesticks put together and are put in a kind of sequential line, and the line is drawn to the pattern made, and it is used to draw whatever it is you see as your chart pattern. So unlike your candlestick patterns, they present themselves over several different trading sessions. Therefore, it covers a very long session as well. The pattern comes into being as price oscillates up and down, and as traders react to various developments, including news releases. What I mean by that is, during trading, there are different kind of things that affect the market system during trading. That's why you come to different analysis, where we have the two basic analysis of the fundamental analysis and the technical analysis. Most times, for an example, if Elon Musk just wake up tomorrow morning and say, all right, so I'll be buying so amount of Bitcoin because I know Bitcoin is going to move from 22,000 to 23,000. Definitely, a lot of people are going to buy Bitcoin because Elon Musk said he's going to buy Bitcoin, wants to buy Bitcoin. So that alone is can be classified under a fundamental analysis. We won't be going into analysis here. So things like fundamental analysis, feeble things or frivolous things such as even news releases, maybe an artist did this or someone else did that, can affect the price of anything or any commodity in the market. For an example, also there was this particular time when C. Ronaldo actually dropped the bottle of Coke for a water, and the stock price of Coke went down for that period of time. That's just an action by somebody, and it affected the stock price of Coke in the stock exchange. So basically, there's almost nothing that can't affect or trigger or determine the price or pattern of price in the forex market. So now let's talk about types of chart patterns in forex. Forex trading patterns are broadly classified into two patterns: the continuation and the reversal. I'll be saying that again: the continuations and the reversal. Continuation patterns come into play after the price have moved significantly in a given direction. They come into play as a trader lock in profits, triggers some form of weakness. So when the trader locks in profit, it's actually sent something to the market. So despite the consolidation, the price often ends up breaking out and moving in the direction of the underlying trend. So when I'm buying, you are buying, he is buying, she is buying, your friend is buying in the market, we're actually sending the signal to the market, and the pattern and everything is going to be changing. So no matter what, after the particular price closes, it is going to send another signal, which going to increase the bullish pattern in the market. So therefore, continuation patterns assume that the price will remain in the same direction after consolidation. What is the direction? The upward direction in the market. So we'll be looking at some of the chart patterns here. We can see the bearish double top, the bearish head and shoulders, the bearish rising wedge, the bearish triple top. We can see the bullish top and double top, the bullish head and shoulders, bullish rising wedge, bullish triple top. There are a lot of patterns. We're just using this as an example. So the common forex chart patterns that affirms continuation in the long run include bullish rectangle, falling wedge, bearish rectangle, bearish pennant, and so on. Okay, so let's just take some time in explaining all of this. So the bearish rectangle, it occurs at the top of the uptrend, characterized by price moving up and down in a tight range that appears as a rectangle. Afterwards, the price tends to break through the uppermost resistance level and continue moving. So this bearish rectangle can happen after different trends, either the upward trend or the downward trend. So now we are going to be analyzing this particular picture. You can see this is from a downward trend. I'm going to show you the one from an upward trend as well. You can see the price is moving in a particular uniform pattern, that is reaching the top line here and the bottom line there, going up and down. Sometimes it doesn't even reach the top line of the rectangle, and sometimes it doesn't bounce back to the bottom of the rectangle here. But there's something that's very certain: this price is just going in a uniform pattern, and it is definitely going to break up at the top resistance level. It is just trying the resistance, it is trying it. So whenever you see a pattern like this, there's something that should come to the back of your mind. Now definitely this price or this trend is going to break off very soon in a bullish pattern. So that is that about the bearish rectangle. So now we are going to move right into the falling wedge. Remember, we are still talking about the bullish pattern in the market. So now if you see a falling wedge is often characterized by the price moving up and down in a wedge shape pattern. I believe you know what a wedge is. After a significant upward move, that is when the market must have gone up in a very significant move, and you see the price narrowing down like a very narrow right-handed triangle. So you should know that is a wedge, and as the wedge narrows down, the price often ends up breaking out to the upside. So when the price narrows down to the very tail end of the wedge, you should expect a particular breakout of the price after that. So I'm going to now let's analyze this picture. I'm actually showing you this upward trend of a wedge. The wedge also does have its own upward or a downward trend. You can see after the price must have gone up at this particular point, then there is a bearish and there's a bearish pull and also a bullish pull upward. It was oscillating up and down, and you can see the price is actually narrowing down just like a right-handed good triangle. And once it gets to this particular tail end of the wedge, expect a price breakout. So whenever you are about to enter the market and you see something like this, you should know that okay, definitely a breakout is about to happen. That is why you know how to analyze the market. That is why it is very important for you to know how to analyze the market as a market trader. It is very, very important. So let's move to the next. So the next one we'll be looking at in this particular continuation pattern. I mentioned there are two types of chart pattern: the continuations and the reversal. So now the next one we'll be looking at is the bearish rectangle. The bearish rectangle often occurs after the price must have plunged significantly, resulting in a slight bounce back, just like a retracement. It is often called a retracement, a slight bounce back, with the price oscillating up and down in a tight range. Finally, the price breaks out and the hedge lowers after breaching the support level. So let's analyze this in the picture as well. All right, so look at this picture now. Yes, I know you might be saying, wow, this looks like the bullish rectangle. Yes, the bearish rectangle is the opposite of the bullish rectangle. So just look at it. The same thing that applies to the bullish rectangle applies to this, but in the opposite manner. The price is definitely going to go down, but most times it is very, 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 very unpredictable. You might see this and yet don't understand. You might feel like, oh, it is meant to go up and just see it going down. You might feel like it's meant to go down and yet going down. That's why it is not often advisable for you to rely on just a particular pattern. Try to draw out as much as possible pattern you can draw from a particular market trend. All right, so let's analyze this pennant triangle here. So the bearish pennant is a forex trading pattern that occurs after the price has plunged significantly. The pennant forms with the price moving in a triangle-like shape that narrows, like a triangle with a very narrow end. The first one which I mentioned was a kind of right angle triangle, but this is going to be like the normal triangle, the balanced triangle. So this is not going to be like the falling wedge. This is going to be like the real triangle. The falling wedge has a right angle triangle, but this has a full triangle. So the shape narrows, and at the tail end you should expect either a break-in or a breakout. So let's analyze this particular image that we are using. You can set the flagpole and you can see the price oscillating up and down, and at a particular point you can map out a triangle here, and you can see at the tail end of the triangle the market did broke in. That is, the price went extremely down. So that is what happens when you're operating on the bearish pennant. All right, so now that we've discussed about the continuation patterns, let's move on to the next type of patterns, the chart pattern that we have in the market, which is the reversal pattern. So you might be wondering, what is a reversal pattern? A reversal pattern signifies that the price will change direction and move in the opposite direction from the underlying trend. For instance, if the price was moving upward, once a reversal pattern occurs, it implies that the price will end up edging lower. So let's say maybe it has been going higher and going higher. Once you notice a reversal pattern, you should know the price is definitely going low. So now, and there are quite a lot of reversal patterns, where I'm just going to be analyzing few of the very important and the main and the most dominant ones of the market. So we have the double top, we have the head and the shoulder, we have the double bottom, we have the inverse and the inverse head and shoulder. So now let's look at the double top reverse pattern. So the first we have here is the double top. So the double top reversal pattern is a bearish reversal chart pattern that occurs in an uptrend. It appears when the price tries to move up but gets rejected twice at the resistance level. For every market trend, there's a resistance level and there's a support line. There's resistance line and the support line. The support line is the lowest the chart is going, and the price action is going for the particular time, whereas the resistance is the highest it is being able to reach so far, not being able to pass. So whenever you see the chart pattern trying to beat the particular resistance line twice, you should know the next thing that is happening is a very bull bearish trend that is going to happen. If it has been going up and up and it is trying to beat the resistance line for the first time, for the second time, the next thing that's going to happen is a bearish run. It might take a little time, it might take a while, it might be long, it might not be, but you should know it is definitely going to happen. It might be a short one or it might be a long one, but it's definitely going to happen. So let's see a real life situation here. So you can see in this particular trade here that the price has been moving before in a very upward trend. You can see this is a very this is a bullish pattern here, and it is going up in a rectangular form to the upward trend. So there's a resistance line there, this particular edge here, and it got to the resistance line at first, came down, oscillated up and up, tried to reach it, it couldn't reach it, came down again. And you could see even from this, if you look at it further deeper, there are two double top here, but the price took one action after the first double top. It went low below to the former support line, and after it reached the other resistance line here at the top, it went very further on a bearish pattern. On a bearish pattern. So that is how you identify a double top reversal pattern. So let's move to the next one in particular. So the next one we're going to be analyzing here is the double bottom. So basically the double bottom reversal pattern is the opposite of the double top. So what does it do? Now, how does it work? It occurs after a significant move to the downside. That is, after the market must have gone to the downside on a bearish pattern. The pattern is characterized by the price trying to move lower twice but gets rejected each time, resulting in a correction to the upside. Just like the same thing to the double top. That is what happened at the bottom in the double bottom. The only difference is the double top goes to a bearish pattern while the double bottom goes to a bullish pattern. You can see, and there's a very significant characteristic to the both of them. It is the W shape. When you see the W shape, you can see from this image I'm showing you right here, for the first 1 year, you can see that the bottom there, it reached this particular support line twice, and afterwards the market went in a very uptrend. In the second 1 year as well, you can see in these candlesticks, the first bottom, the second bottom, and we did what went higher. So it always have this W characteristic, and that is how you get to identify a double bottom reversal pattern. Alright, so the next one we're discussing here is the head and shoulder reversal pattern. The head and shoulder reversal pattern is a chart pattern characterized by one high peak and two peaks on the side that are slightly below the middle peak. Once the pattern occurs in an upward trend, it signals that the price will end up reversing, of course, and tanking. So what that meant actually is just like, imagine yourself, you have a head and you have two shoulders below your head that are even, and you know your shoulder is below the distance between your head and your shoulder. So just imagine that whenever you see such points in the market trend, you should know that is a head and shoulder. And for a proper real life example, if the market is going in an uptrend and it gets to one particular point, a particular resistance point went below and went high again, reached an higher resistance point, came down and tried to go up but couldn't go beyond the first resistance point, or slightly beyond the first resistance point, then you should know that is an head and shoulder. The market is, or the trend is definitely going to tank. You should expect a bullish run, and same applies to the opposite. So let's look at these pictures here. I'm going to be showing you 3 pictures about this. Look, you see this first illustration here. You can see the top peak and 2 bottom peaks here, and you see the next thing that happened in the market was a downward trend. And you can see in an opposite situation, you can see in this particular bearish run that there's a very low peak here, and there are 2 lower peaks for the bearish run. And what happened to the pattern? It went in an upward trend. And I like this very last image. Why? Because it is confirming 2 things at a time. Here I can see a head and shoulder pattern. You can see in the place I marked here that afterwards the market went in a downward trend. But did what after the downward trend? Yes, the head and shoulder really occurred. The market went down according to the analysis, but afterwards it went up. Why? Because now you can see that I tell you that sometimes the pattern will definitely occur but might not last long because they repeat themselves. Now you can see after this head and shoulder pattern, it came back to a double bottom pattern. You look at it here. After the second tanking, after the tanking, after the head and shoulder pattern, you can see it is almost on the same support line, almost the same, that's the word, almost the same with the former support line, making it a double bottom. And the market did what? It went in an upward trend. Definitely this is a confirmation to let you know that this analysis works. If you are in the trade, if you are in an open trade and you are seeing all of this, these are going to guide you. This is why technical analysis is very important. These are going to guide you to know the price action you should take, either you have to buy, either you have to sell, either you have to watch, either when you have to come in, or when you have to exit or enter a particular market. So let's move to the next reversal pattern we'll be discussing. So we are going to be talking about the inverse head and shoulder, which is just like the opposite of head and shoulder. So these are forex trading patterns, or definitely the market trading patterns that occur at the base of the price chart after the price has significantly decreased. So just like the head and shoulder, I was giving an illustration in the bullish pattern. So just imagine it to be happening in a bearish pattern. So I'm going to repeat the particular image I showed you before. You can see here in the bearish pattern. You can see in the bearish pattern, it has a very low peak and 2 lower peaks beside it. So this is definitely an inverse, what is it called, head and shoulder reversal pattern and the market trend. So that will be all on the chart patterns I'll be discussing in this particular course. So for clarity's sake, now let's discuss the differences between chart patterns and candlestick patterns. So the candlestick patterns are formed by combining one or more candlesticks, while the chart patterns are formed as price oscillates up and down as a reflection of psychological and fundamental factors. Secondly, candlestick patterns occurs in a brief period, as it includes 1 or 2 candlesticks, while in chart patterns mostly occurs on longer time frames, so maybe in hours, in minutes, in a day, in a week, in a month, depending on the kind of trade you're opening. So candlestick patterns are ideal for quick entry and exit into the market, perfect for scalpers. So what are scalpers? People that just quickly come into the market, take a little profit and run out of the market. Those are not long-term traders, but chart patterns are ideal for long-term buying and selling signals. So if you want to be giving out signals, you shouldn't be considering the candlesticks, you should be considering the chart patterns. So now the candlesticks, and lastly, the candlestick implies price direction over short period. whereas the chart patterns implies direction over a very long particular period. So that is where we're going to be ending this on the discussion of chart patterns and candlesticks. So stay tuned for more videos on trading analysis, especially with technical analysis on Emerald Digital Finance. Thank you.